Hello there. Welcome to the Geek and the Guru Series 66 podcast, episode 2. Oh boy, here we go again. I love it, Dean. With me, of course, Dean Tinney, the Series 7 Guru. My name is Brian Lee. I'm the test geek, of course. And we want to look at the investment vehicle section for the Series 66 today. 17 questions. Not too bad, but I want to caution folks, Dean, about this because I often see if people don't make the grade on the Series 66, it is often because of the investment vehicles of all things. There's only 17 questions, and by God, by Joe, by cracky, you just passed the Series 7. Why would it be a difficult area on the Series 66? That's what we want to bring to you today is some of those areas. Dean, your thoughts?
Yeah, I was just going to say too, you got to respect the 66. So I think sometimes there's two things. I think, and we'll be talking about it, Brian. The first is that I think that this hubris, lack of respect for the 66, I got a little bit of feeling full of myself passing the 7. You should feel really good about making your mark on that 7. And then I think the second part is they look at the book, they look at it, it kind of looks familiar. And then they say, oh, I know this stuff. This is the 7 over again. No, it is not the 7 over again. And Brian, I think we were talking that what we want to do is point out some of those areas that are a little different from the 7, tested a little different, things you may not have encountered on your Series 7.
That's exactly right. And I believe we touched upon this quite a bit in episode 1 about, the hubris and taking your foot off the gas for the Series 66. Right. So we come to you again to remind you, don't take your foot off the gas for the 66. Yeah. Again, and I think I mentioned this in the first episode, the pass rate for the 66 is slightly less than the 7. Not just trying to scare you here. Just want to make sure that you be as diligent with this puppy as you were with the Series 7. You just passed that thing. Great job, right? We want to get you the old P on this one.
3-0, not 2-1. 2-1 is very depressing.
So let's take a look at some areas on the investment vehicles. Again, 17 questions. Obviously, I don't know why, Dean, I hear you say this quite often, that a lot of these exams, the FINRA exam, the NASA exam, think we're going to be bond traders. Why is there so many bond questions on these exams, right? Oh, my goodness.
I think there's truth in labeling. I always joke on the 7, for years, people have referred to the Series 7 as the stockbroker's exam. And I've always said it should be referred to the bond broker's exam because there's way more questions on bonds. And the same thing on 66. I don't know if I would say there's more bond questions. I think there is. But I also think that it's not the equity securities usually that people struggle with. That's right. It's the bond stuff.
That's right.
More than the equity stuff.
So I'm assuming that everyone remembers their teeter-totter, the bond price, the bond yield relationship, the current yield calculations, and that YMCA was the acronym that I like to give in class for current yield, right? Yield to maturity, yield to call. Yes, yield to call is out on the end there. Right. So all of that's pretty much the same. The interest rate risk, maturities, longer term versus shorter term. But one risk that you'll probably see on the 66 that isn't discussed much, if at all, on the 7 is duration. And if you don't mind me saying, duration has nothing to do with maturity.
Yeah.
That's the common.
I'll let you comment on that. The way I say it, Brian, is I've had some serious bond geeks, pun intended, Mr. Test Geek. But they say, Dean, I don't like that teeter-totter or seesaw that everybody uses. I go, why? And they say, well, it really isn't accurate. Bonds don't really have a linear relationship like that. Boy. I go, well, true, but I like it because it turns judgment questions into aim and shoot, point and click questions.
Exactly.
And, what I think is duration kind of reflects that that's not a linear relationship. You may be where you're going with maturity, right. Geeky term, convexity, the idea that it isn't a linear relationship. I know that's where you're going with the maturity, Brian, but that's what I usually tell people. I still think that for the most part, what they've learned in 7 can answer questions about duration.
Really?
Yeah. What do you think, Ed?
Well, what I generally do, and again, turning mashed potatoes into premium vodka, right?
Yeah.
I even get a little heat from the outside world and social
Mhm.
media because of the way I address something. Because again, I'm not concerned. My ego's not big enough to worry about educating people. I just want to get people past an exam.
Right.
That's all I care about. So what I generally tell people about duration, I'll always ask, what's a general definition? 5 words for duration, right? And they start with the word maturity every single time. I go, and stop. It's coupon rate. Huh? It's coupon rate. Because what if you get a question with 4 bonds as answers and they all have the same maturity? Which one's going to be more volatile? Well, you're not going to be looking at maturity dates because they're all the same. It's the coupon rates. The lower the coupon rate is the most volatile when the maturities are the same. So that's what I want test takers to focus on is the coupon rate.
Well,
I
yeah.
do go into the basic definition and how all
Yeah.
that works,
Yeah.
the amount of years it takes for the interest to repay principal.
Yeah. I just say long and low. So long and low.
I
If
hear
it's
that. Yes.
if the maturity is the same, then it's the coupon. But I'll add to that. I agree with you, Brian, because that's what the coupon does, right? It acts as a stabilizer on the price.
That's
The
right.
higher the coupon, the more likely somebody's going to step in and buy the bond to collect that higher semi-annual payment
Right.
than somebody's going to step in. So in general, all investments that have income streams are more stable than investments that do not.
Right.
And investments that have higher income streams are more stable than investors not. I use the 0 as the exact opposite of that, right? If it's a 0 coupon bond, well, then there's no stabilizer. Right?
That's right. That's right. And that's where the duration leads to
Right.
is the 0 coupon bond, which we did learn in Series 7 is almost always the most volatile.
Right.
Well, again, on the test, you might see one question on it. It might be a basic definition. It's a measure of bond volatility.
What do you think, Brian, about longer duration versus shorter duration and longer duration meaning more volatile? You
I
think
don't think it gets into that kind of depth. I really don't. Like I said, I do give some background to it, right? Because I do like to give a little context to a concept, but not too much because anything that goes in that way is going to be coming out that way, right?
Yeah.
So I try to limit
only so much space
exactly.
in the brain housing group.
Right. That's exactly right. Another concept, that comes up on the 66 are the Treasury inflation protection securities. It's funny. I used to say, why would anybody want to buy these things? Because we haven't had inflation in 20 years, right? Mm-hmm. Until the last 18 months. Again, what's the most important thing to know for answering test questions on tips? It's the principal, not the coupon. Okay? Because you have to make these semi-annual adjustments based on the CPI, the Consumer Price Index, which adjusts the principal amount, not the coupon rate. That's the one thing you have to remember. The coupon's fixed. That's not ever going to change.
It's the principal value the government's giving you back, and it's done semi-annually, I would point out. And I don't think a lot of times test prep vendors get into a higher complicated math about how it compounds. But, I would just tell you that as a test taker, you don't have to do the compounding. You could just, if CPI is 8% of the par is $80 twice. And because of compounding, it could be something north of that. So you can kind of just do simple math, go above that.
I recall a question I was given about an investor has a tip. It's a CPI at 3%. What is the correct coupon rate?
Oh, there you go.
It was a 4% tip.
Well,
so even after the adjustment, guess what the coupon rate is? It's still 4%.
I love that because that turns it into an aim and shoot point and click question.
Exactly.
Instead of judgment question.
Because we know the 66 is not calculations. One calculator.
I just finished the tutoring session today, Brian, and it's aggravating because it's aggravating because we know that the test takers do not.
I know.
And so sometimes they lose focus and they start to do too much on the quantitative side. I know, Brian, are you ever tempted to tell them that, that just guess B on these because you could devote your
I don't.
your
I
your
don't.
entire study period to
I
quantitative analysis, and it's only like 3 points. You're better served doing other things. So, anyways, I
well,
still did it. We went over that stuff, but
That's right. I always tell the story. Remember from the Series 65,
yeah.
I get emails all the time. Can you send me a list of formulas? And I say, no, I'm not going to send you a list of formulas if you don't know their context around them, where
Right.
they belong.
Right.
As I go through my content, I'll show you where, if there is a formula, whether if you have to calculate it or just regurgitate it, a point and shoot question, as you said.
Exactly.
So I don't. Sometimes, on the current yield questions in Series 65, sometimes 66 as well. When I say it's a 6% bond, it's trading at 920, right? I give them 4 answer choices for the current yield.
Right.
And of course, only one of them is above the coupon rate, which is the correct answer, right? I said, okay, please find the current yield. And then I see all these people in the class, right? I go, stop, throw the darn calculator away. You don't need it. They don't test your math skills. They test concepts.
I even add to that, Brian. I say, if you think it's a math question, just read it once again, just to make sure it really is, because it could be a question like that where it looks like a math question, but it's more of a relationship question.
I found some of these folks are just so intimidated by math. There's a lot.
And then the other thing I would just make a note on the tips is doesn't beat inflation, keeps pace. If you've got to be carefully, if you're trying to outperform inflation, common stocks over the long term. So
that's right.
Just make sure that answers that.
That's right. So tips, again, like I said, is one area on the 66 you might see, and you might see one question on it. I don't think there's much more than that you haven't seen on the 7. Okay.
Yeah.
Equity securities. Not a whole lot new that I know of, except for the analysis, the valuation factors that go into, because remember, when we mentioned this, I believe in the first episode, a very important role of investment advisor firms, if not their reps themselves, are constructing structured portfolios, right? 70-30, 80-20, 60-40. And you got to decide what investments to put into that portfolio. That means you have to analyze these investments, right? You have to do your due diligence to choose. So that's another big difference between the 66 and the 7. It's a lot more on the quantitative analysis, the valuation of securities that you don't see on the 7, right?
Totally agree.
One of the new changes, we mentioned this with the 65 podcast about the June 12th changes. And there is a question or two that's been showing up on a very specific type. Why NASA chose these, I don't know.
It's amazing.
Is the SPAC.
Crazy.
What do you think about it? Have you seen some SPACs out there?
I have. They were a fad, and I think to answer the question, that's why NASA incorporated this. They always are. All the regulars are always behind the curve. Once the fad has passed, is when I shouldn't say fad, because with people who lost a lot of money in a fad. So that's what triggers NASA on this. And a special purpose acquisition corporation or blind pool, they've been around for years and years and years. And the big problem with them is a lack of disclosure, that it's a lot easier to raise money from the public with less disclosure by having a SPAC that goes out and acquires a private company.
Right.
And so that's why I think they're testing on these. It's one of those things where, the classical line from, the days is, where are the customers' yachts?
Yeah.
In terms of the brokerage business. And this is usually the promoters that are making the money off these, and investors have been taken advantage of, according to NASA. So I think that's why it's on there. I think you should be, as an investor and as somebody who, if you're selling a SPAC or putting in a portfolio, because remember, it's really based on the ability of the promoter or sponsor to go buy at an attractive basis an acquisition for stock.
Right.
That will work out. And usually they're willing to overpay, because the reason they'd overpay, Brian, is if they don't come up with an acquisition, they got to give everybody back their money.
That's right.
And that's kind of hard thing to get back people money. So, if it's a closing at the last minute,
That's
I
right.
thought the debrief that you had was I've now heard it since, and you always tend to get some good debrief. And I'm like, wow, okay, I've never heard that. In fact, you even asked me that based on that
That's right.
question debrief. I go, I have no idea. I would think it's whatever the market will bear, but not
Exactly.
so. You want
So
to share that debrief with on the episode?
absolutely, of course, the special purpose acquisition company is a blind pool, often referred to as a blind pool, is basically a shell. They don't do anything other than go out and acquire companies, right? And of course, they acquire that company, they can do all kinds of things, and that's a whole
Right.
different story. But they need to raise capital in order to acquire these companies. So what they do is offer shares to the public in the shell company, the SPAC. That raises capital to purchase, to acquire this other private company, public company, whatever. Now, because it's a shell company, it doesn't have any revenue, it doesn't have any earnings. So the lack of disclosure. So, how do we know how much these things are worth? How does an underwriter value the shares? So that's why they fix it. They fix the share or unit price of SPACs at $10 per unit. That is a fixed price for SPACs. For those of us from Series 7, we often talk about how we value IPOs, right? Supply and demand, earnings, financials, fundamentals, all sorts of things. But we don't have that with SPACs. So the regulators have said, $10 sounds good.
Yeah, first time I ever heard it was from your debrief, and
Somebody said, how much are SPACs offered at? I go, and I thought the same thing you did, based on earnings. I go, wait a minute, they don't have earnings. I don't know. So I had to go do some research to actually find the answer to this.
You've got questions like this. I don't know if we're about 17 minutes in, and if you're watching our podcast series, I love little things like this, these nuggets, these golden nuggets in our podcast. Because I'll tell you what, when I take a test, Brian, I always like to get to the first question I know the right answer to.
That's right.
Hopefully I'm not like 15 deep. I'm wishing for our 66 test takers. Question number one: what is the IPO price of a SPAC? Woo! $10.
I kind of think this is what makes my premium vodka taste so good.
There you go.
It's from the hard work of all of us.
That's exactly right.
One other thing before we move on from SPACs.
Sure.
You even started talking about these sponsors.
Yes, underwriters.
I believe technically in the industry they're referred to as finders.
Well, they can be because they're going to go find the acquisition. So
exactly.
And sometimes they come with management teams in place. I've had some experience in doing a very similar kind of transactions, reverse mergers into public shells. And so, and sometimes you start with a team and then you go find them a business or they build a business. So yeah, indeed. And then the finder typically is getting a percentage of the shares. So,
to me,
the vast majority.
That's right. To me, this whole thing seems so esoteric that, what's it doing on a test, for crying out loud?
Well, they were, celebrities promoting their own versions of SPACs where they were going to go, do whatever they're going to do. Virgin Space.
Okay.
Had one.
I'll put $20 on the table that this thing ain't going to be on this test a year from now.
We'll see. We'll see. I'm with you.
Yeah.
It's like we talked about digital assets. Maybe we'll talk about that as well. I think they're always behind the curve in trying to protect investors. It's regulation or protection that comes after the fact, not typically before the fact.
After the horse has already left the barn.
Exactly right. Right. Yeah. 33 and 34.
That's what happened
prior
to that. That's exactly right. After the crash of 29,
yeah, right.
Up with two laws in 33 and 34.
Insider Trading Act of 88. You might think we had problems in 87. You'd be right. In fact, sometimes when I'm at conferences with regulators and they're introducing a rule, I'll say, "What's the story behind that one?"
Yes.
They go, "What do you mean?" I say, "Well, there's got to be a story. I mean, there's always a story behind whatever kicks off that regulatory, initiative of whatever it is."
That's right. Investment companies, open end versus closed end. Again, probably not too different from some Series 7 stuff, but it happens to be a little bit more pointed on the 65, 66 exams. The differences between the open end and the closed end. Open end, of course, priced once a day at 4 p.m. Uh, based on the value of the securities inside the portfolio. So it's only valued once a day. And then they start getting into the share class, Class A, Class B, Class C. Why do they still ask questions about Class B shares? They haven't been able to be sold since 2010.
I got to tell you,
FINRA
Brian,
doesn't allow their sales, but they're still on the test. Remember, Class B.
it's the same with Coverdale's. I don't know of any financial institution anymore
It doesn't
that
cover that.
even offers Coverdale's, because the 529s, I tell people on the test, you will say the 529 is always the better recommendation.
That's
I
right.
mean, again, I think it's easier to add things than to take away things.
That's exactly
So,
right.
nobody hits the delete key. Even test prep vendors, I have to say, will never call their banks for questions that nobody has seen for years. And I think NASA, FINRA, no different. They don't typically take things away, even if they know they're inappropriate.
It's antiquated. Yeah.
Yeah, even if they know most people are never going to be doing business in those things. By the way, I usually say the reason they don't allow it anymore is because they were so confusing that even the brokers who sell them couldn't figure them out, right? So,
I tell a little different story, but
do
it
you?
doesn't matter. It really
There
doesn't.
you
The contingent deferred sales charge. I do. You know what? I still add the suitability factors to the different share classes.
Yeah, that comes
A
up.
is long term, large
Large
investor.
amount,
Right.
breakpoints.
That's
B,
right. B is
smaller
smaller investor,
amounts.
longer
Yeah,
time.
exactly.
That's right. That's right.
Do you add, Brian? I usually add the you can't what they're concerned with, as well as misuse of no load terminology. That a
I don't
contingent
get into
deferred
that too
sales.
much.
Okay,
No,
but
no,
anyways, a contingent deferred sales charge is still a sales charge, though.
that's
Or
right.
I always joke, I shouldn't mislead people and say, "Hey, Brian, you don't pay me; the fund pays me." No,
Yeah,
it's like using a travel agent. No, that's a bad analogy, right? So,
that's exactly right.
open and closed end, same thing. Supply and demand
Yeah.
versus
Trades on the market.
NAV plus sales charge, right?
And the closed end still does calculate the NAV each
Yeah,
day,
yeah.
but the market price is independent of
It's the
that.
only fund that could be trading at less than the NAV, right?
The trades at a discount. That's
Yeah,
right.
good,
That's
good.
exactly right.
Yeah.
Yeah. So that's the
Futures
big
and
thing to
options.
remember about closed ends.
I think that I think, and Brian, maybe we both agree on this. This is very familiar, but be careful of those familiar things like open and closing. What I mean by that is, I think there's no different question on 66 about open versus closed. It's there for sure.
Yeah.
Then there is 7. Hopefully for you, that's the case.
That's right.
But beware.
Yeah.
Futures and options.
Options, you might get 2. One of them's got to be a hedge, and it's ain't no different than what you've seen on the 7. It's never an issue. I'm not going to say ignore it, but again, I don't know how much I trust the textbooks and how far they go with it. There's just not a lot of option questions
I
anymore.
agree with you.
The one thing you got to watch out for are the futures, because that's
Yeah.
not on the Series 7,
Right.
right? Commodities. And one thing they also for the Series 66, it might be more of a law and regs question, is that futures and forward contracts are not securities. They're derivatives, but they're not securities. You don't have to.
Yeah, I think it's pretty
agents.
basic. If you just think of a future, I just think of a future as being even simpler than options. So you're either going long or short. If you
That's
think
it.
the price of the underlying is going up, you go long the futures. If you think it's going down, you go short the futures. And then again, it would be no different than, again, whether you're speculating or you're hedging, it's still going to be that price on the futures. And the other thing is that the contracts and the futures and the forwards are better than a negotiated contract that you and I might have.
That's
That
right.
they trade.
There's one thing I depart with the textbooks. Well, actually, there's more than one thing that I depart with the textbooks. But when it comes to forward contracts, I call it, for anyone who has seen my Series 66 video or a 65 or taken my live class years ago,
Yeah.
I tell people this is the Farmer Brown question.
Yeah.
Farmer Brown ain't going to be buying forward contracts. It's not really spelled out that way in the textbooks. I tell people that forward contracts, because they're not standardized, they're just whatever two people negotiate.
Right.
John and Jane Q. Public are not sophisticated enough to be playing with forward contracts. So if you see a Farmer Brown concerned with his wheat crop, you sell wheat futures. Don't
Yeah,
get involved in forward contracts.
well, I always, the way I like to say it, it sounds like we're saying the same thing. I always say when I teach Series 3, and sometimes it's at places like Cargill, people, I joke that people in the Midwest are as obsessed about the price of beans as we on the East Coast and West Coast are about the stock market. I always say you do in the futures market today what you're going to do in the cash market later on. That's called the spot market. So you're talking about Farmer Brown. Right on, Brian, right? Farmer Brown is going to be selling soybeans. And so that's what he's going to do in the forwards market. He's afraid the price of beans, he's not afraid they're going up. No. He's afraid they're going down. So he's going to do a substitute sale. He's going to buy the future, sell the future short, hoping that future, if he's correct on the hedge, goes down. He'll make up a little bit on that futures contract that he lost in the cash market. But I agree with you. Again, it's such a challenge, 66 test takers, to make decisions about how much time you want to go into these areas where there might be 1 or 2 points. And I think we shared them with you right here. And so do you want to spend, I don't know, 100 text pages and the test prep vendor?
We just did that with options on Series 7. We spent 3 months on that crap, right? Yeah. So again, it's not really covered that much. Yeah. Investment analysis. Here it is. This is my baby.
Okay.
This stuff is different from the 7. It's far more into this analysis when it comes to debt and or equity. The most important thing, of course, would be the discounted cash flow. We're trying to remember, right? Let's just pretend we're constructing this portfolio. And it's a 60-40. So we got 40% fixed income and cash equivalent. So we got to choose our bonds wisely. Which means I want to pay a fair price for the darn thing. And that's going to be determined by how much cash, how much income this bond's going to pay me over the life of the bond. That's what discounted cash flow does. Definition: it determines the fair market price for a bond based on future cash flow. That's it. Fair market price. You know another word for that? Present value. Okay? That's the basic definition.
Yeah, I love it. I just did a tutoring session today, and that's exactly what we're talking about. We were talking about a bond that had a 6.5% coupon. There should be a review, hopefully. That's $65 in annual interest, 2 payments of $32.50, 10-year bond. That means we're getting 20 payments of $32.50. What is the present value of 20 payments of $32.50, realizing that money today is more value than money down the road, right? So the $32.50 6 months from the day, and then your point at present value. I always add to that, Brian, we're not going to have to calculate it, right?
Please, no.
We might get a present value comparison to a price.
All right.
And you call that present value. And the difference might be what we call net means different, net present value.
That's right. One question I generally point people to is what are the constituents of an investment that determines the long-term cash flow? It's the coupon rate, also known as nominal. Be careful of the synonyms, and which is a percentage of the par value, also known as the principal. Be careful of the synonyms, and the maturity, which determines, just like Dean just said, the number of payments you're going to get. Those 3 things is what determines the cash flow in the future. Now, if you're given that choice, and there's 4 answer sets, each have 3 constituents. One of those answer choice will say market price, coupon rate. No, market price isn't a part of the cash flow. That's what we're trying to calculate, is that market price. That's the X in the formula. So any answer choice you see in that set that says market price, you're going to eliminate it immediately. That doesn't determine income. It determines yield, but not income. Right?
Love it. I love it. I also just would add to that, this is associated with investments that have income streams. So when applied to common stocks, we call it the dividend discount model.
Right.
If I'm going to get Bank of America quarterly dividend of 21 cents, I get X number of dividends, same thing. And then if we assume the dividend is going to rise, 18 cents was what Bank of America's former dividend was. Now it's 21. I think it may be 24. That would be called the dividend growth model, and that would justify a higher valuation.
That's
Now,
right.
we're not going to have to do the math again, but if we get the present value, right, and we can buy it today at more or less, then that would be something we'd be interested in. What do you think about two things, Brian? I'll ask you, because I know besides being a test geek, you're a math geek. What do you think about this concept, two things, of net present value and internal rate of return as it is associated with discounted cash flow?
I try to cover it separately because it's really its own separate. And I believe we covered it with episode 1 on the business information. It is a discounted cash flow valuation, but I try to cover it separately again because I'm just worried about the test definitions of IRR and net present value. And
the only reason I bring it up is because I usually touch on it. If we don't have net present value, then that number is the internal rate of return.
That's right. That's exactly right. The one thing I'm going to disagree with you just a tad.
Yeah.
You might have to calculate the dividend discount model.
Really?
Annual rate. Annual income divided by rate is what gives you the present value. There's a couple of tricky, sneaky ways they can ask.
That's like your $10 thing. That's new to me as well.
They might just ask for the formula and not ask you to actually.
Well, what I've heard is, in terms of debrief on dividend discount model, is in what situation can you not apply the dividend discount model? I think the obvious thing, remember, would be a stock with no dividend.
That's right.
Another question is, where can you not apply the dividend growth model? The test is always negative. You can't do it in a preferred stock because the assumption is the dividend isn't. And then your point, a very strong agreement on this point about the math and the inputs, more than can you do the math, but the idea of what does the math end up being? What I mean by that is the end result. And the other thing that I hear sometimes on debrief is that the dividend growth model would result, no surprise, in a higher valuation. I'd be willing to pay a higher price for a stock with the assumption that my dividend is going to grow than a stock in which I don't have that assumption.
That's right. I don't know if you've ever heard of my infamous grandma in perpetuity question.
No, I have not.
It's been around, the concept. I'm going to dance around this a little bit.
Right.
Grandma wants to pay her 7 grandkids $1,000 a month.
Oh, I think I saw one of your practice questions.
That's exactly right. So how much would she invest if we assume a 3% return?
Yeah.
So that's $1,000 a month. That's $12,000 a year divided by the rate of 3%. That's a dividend discount.
Oh, there you go. I always wonder why.
Now, they don't mention any of that about dividend discount, but that's exactly what it is.
Yeah.
I could also tell you that the dividend discount model calculation is just an inverse of the current yield formula.
Wow. That's why I said, not only he's the test geek, he's the math geek.
My vodka's tasting better every day, pal.
I was wondering why you had that grandma question in there.
I love it. I love the grandma in perpetuity question. Yeah.
All right, on to technical and fundamental analysis.
I don't find this to be as much of a problem on the 66 as the 65. Because the Series 66 just took the Series 7. They're a little bit more in tune with equity, securities, and those sorts of things, where Series 65 is a larger population of non-finance people. But anyway, technical versus fundamental, obviously finances. So I always tell people to connect F for fundamental, F with finances. Duh. But, they can get a little esoteric with that as well. It's PE, it's earnings per share. Anything that has a financial ratio to it is fundamental analysis. Technical, stock charts. And in Series 7, right? Heads and shoulders, resistance and support, price and volume, history. That's all technical analysis. And that's really the difference. The only question you might see is all are fundamental except something like that.
I don't think what is used in both of those schools.
That's right. That's exactly right.
Well, listen, insurance products. Ugh. I'm joking. I come from the security side of the business, Brian, and I always joke that stockbrokers sell greed and insurance agents sell fear. Stockbrokers say, wouldn't life be wonderful if? And an
Yes.
insurance agent say, oh, wouldn't life be terrible if? Now, if you happen to be duly registered, then you can sell both fear and greed. But you have a good question on your practice exam on equity indexed annuities. Key point, you cannot lose your principal in an equity indexed annuity, and that's why it's an insurance product and not a securities product. This isn't like like a variable annuity where there's a mutual fund. And then I think, Brian, you have a good question that I get a lot of debrief that people see about how we do that reset on the equity indexed annuity.
That's right.
You want to speak to that a little bit?
Yeah, it's very interesting to me because, again, it's a concept for me that's just because anytime you guarantee something, that just, my brain
Has
just
to be insurance.
explodes. Exactly. That's
I say
insurance.
there's two nasty words we don't use in the securities industry: the word guarantee and the word approve.
That's exactly right. That's exactly right. So, and I also tell people that people make a lot of money selling these things because how would you like to invest in the stock market, participate in its growth, and never lose money?
Woo!
That's an equity.
That's
I know.
insurance. That's insurance.
But
And that's why the product was designed, though, Brian, right? So insurance.
that's right.
agents
But there's
didn't
no
have to
free
do
lunch.
securities registrations. Yeah.
How do we pay for that guarantee? Well, you don't get all of the stock market's return. You only get to participate in a percentage of it. That's called the participation rate, like 80% of the market, right? The insurance company keeps the other 20% to insure their butts when the market goes down, right? And they also cap it. So if the market goes up, remember the late 90s, early 2000s, the dot-com bubble, when markets were going up 40% a year? Well, you're capped at 15. Sorry, pal. You're not getting any more than that.
The thing I would add to that, Brian, is that the one I get a lot on debrief is to recognize there is no negative reset.
That's right.
So where they give you that sequence of returns and then
Yes.
the market tanks, it goes down
Yes.
20 and they try and bait you into resetting that thing at, a negative number. No negative reset year to year, right?
No. The value never goes down.
Right. And then life insurance shouldn't be sold as an investment. And I know you have forgotten more about life insurance than I have ever known. So could you speak to what do you? I now call me out if you think I'm wrong. 2-3 questions, maybe max.
At least, yeah. I think there might be a little bit more. Yeah. Well, since they've actually reduced the number of investment vehicle questions, that's probably accurate. Now, I want to tell the story. A gal who'd gone through my Series 7 class did extremely well. Back in the day when they used to give you your passing score, she scored like an 84% on the Series 7. Wow. It was really good. Smart lady. And then she came in, took my Series 66 class, and then a week later, she goes, Brian, I got a 69. I know. And she goes, man, it was just those darn insurance. Now, she did not take my class. And she called me up and said she got a 69. I said, take my class. And I go, all right, this one's for you. And I have a chart, a very simple chart in my class notes that depict the differences. And there's only really 3, the whole life, the variable, and the universal variable life, UVL. Now, if you're insurance guy or gal, be careful because there's a lot of different types of universal in the real world. In the test world, there's not. There's only one. And it's only a separate account. That's it. So there's no guaranteed death benefits and no guaranteed cash value in a variable universal, VUL, sorry.
Yeah.
Okay. And you're even allowed to skip premiums.
But then the assumption is they're going to deduct the cost of insurance out of the separate account.
That's exactly right. Typically, from a suitability standpoint, it's usually for a little higher net worth individual who does the VUL. Right. And that's really it. You have to associate the death benefit, whether it's guaranteed or not, and the cash value, whether it's guaranteed or not, with the different types of life insurance. And that's what that chart does. And it shows you the different buckets that the money goes into. It's a pretty simple, easy diagram to show you.
We could probably tell them that you can, time for me to do a commercial for Brian. Brian has been very kind in allowing access to some of his content on our YouTube channel, but he does have paid for supplements. And I think the entire video series, get it now. We're coming to you in the end of November last part of 2023, and I think you're going to get some price increases from the test geek. So go act now. But what I was going to say is, if you don't want to go all in on Brian's videos, which I think you should do as a supplement, and he gives our viewers a 20% discount. Guru 20 is the discount code. He sells separately the PDFs he's referring to, and I highly recommend. I use them in a lot of tutoring sessions with people, whether it's that chart. You have another one where it's, should they register? What do you call it?
Definition
I
of
think it's called the
persons.
cheat sheet, right? The cheat sheet.
Yeah. You don't like that term, do you?
I don't, because I'm afraid someone's going to leave it at the exam site. And
Oh God, no, please.
But anyways, but
am I allowed to take this into the test center? No.
I do love the thing, and I think that's like 40 something, Brian, just for the PDF.
For the combination pack, yeah.
And that comes with a practice final that is just spot on. So, I know some people starting out maybe don't have the resources, but if you do have the resource to invest in a paid supplement, I highly recommend
Couldn't hurt.
Brian's products, particularly the PDFs, if not all in. Go all in.
I appreciate that. But again, for you Series 7, if you don't have a lot of insurance background, be careful with these, the indexed annuities, the life insurance. That's definitely stuff you haven't gotten on the 7 and will be on the test.
No, I can't imagine I call it the dream draw versus the face of death draw.
Yeah.
And I can't imagine any draw. Usually when we talk about draws, it's probability. And I can't think of any less than 100% probability. I'm joking, but high probability you're going to see equity indexed annuity. People tell us they see things. We're not surprised. Every once in a while, I told you, Brian, I feel like he gets these weird ones that end up being there before I do. But like that $10 thing, I've never heard of that before. Right? But we're prepared for those, hopefully. And, make sure you get all those layups that you're entitled to and those kind of questions that everybody knows is there.
That's exactly
right. All right. Last thing we got, Brian, for tonight's episode or today's episode, wherever you're watching this, is other assets, which is commodities, precious metals, and digital assets.
What is a precious metal?
Not copper, stupid, but testable.
Platinum.
Yeah.
Platinum, gold, and silver
there
are
you
precious
go.
metals. Nothing. Copper and zinc are not.
Yeah. And then why would you buy commodities? Remember, as an inflation hedge, that's certainly there.
Right.
What about digital assets? We have an episode, I think we covered registration. I think digital assets are showing up as this idea is, does a digital asset, is it a security or not? And let's assume that for test purposes, it is. Well, then that means it needs to be registered. And the people who are selling it need to be registered. The exchange on which it's being sold needs to be registered. It's right now the NASA and SEC against, Coinbase and Binance and FTX. That's the intent, I think, on the test. I see a lot of people making videos on what they think are the digital asset questions. And I really think it's digital assets as securities that are where these questions are coming from.
Can I tell you what I think?
What do you think?
I haven't a clue.
There you go.
My vodka does not have any digital assets. I've not heard any digital assets. They could be there. I'm not denying that they could be. I have no clue. I've not heard a thing.
Well, we'll continue to collect debrief. I have heard a couple times about a digital asset question, but they usually start those questions as experimental questions.
That's right.
Before they show up, they test them for validity before they show up in GAAP.
Wouldn't they have to have a question, something about the volatility of those damn things? Right? I mean, those things are all over the place.
Well, I think it's kind of like the SPAC question. Why is this showing up? Because again, like SPACs, we had non-fungible tokens. I
understand that. I understand. But wouldn't they have a question pertaining to the volatility of those assets?
I don't
know. These firms are acting as their own exchange.
Right? Wouldn't it be nice to be on the NASA cocktail party when they discuss the Q Bank?
Yeah, wouldn't that be?
I always joke, Brian. Let's remember that the NASA guys are attorneys. They're not really investment professionals.
That's right.
Most of them. So
that's exactly right.
Your point. Would you think they'd have volatility? I don't know.
Would it be correct to say? Please help me here, right? Yeah. To refine my vodka a little better. Yeah. That the firms who trade these for customers are basically acting as their own exchange, right? There's no centralized exchange.
No, there is not. There is
So
not.
each firm is kind of acting as their own
Well, that's why the
exchange.
firm would become important. Like if it's Fidelity, I would have no worries if they're the ones providing this.
Exactly, but
But
it's
if
not.
it's, you know,
Yeah.
digital assets are us, maybe not, you know.
So I haven't a clue. I don't know
Uh,
what any questions about digital assets are showing up on the test. I've
Well,
never.
you know, we do our live streams every Tuesday, 5 p.m. And our very special guest for most of those Tuesdays is Brian. And whether Brian joins us or not, when we hear, we will certainly put out the broadcast.
We certainly
Hey,
will. Yeah.
people are reporting. That's typically what one of the things we do on our Tuesday nights. Next episode, Brian, is going to be client customer investment recommendations and strategies.
Yep.
30 questions. I don't know. We'll probably talk about where we'll break that up or how we're going to do that. We're trying to get these. Well, I guess we shouldn't, you know, probably. I know this is video, but we're trying. This is a new series. We did a 65 series working on this one. We're trying to keep a pace about once a week. So if you're joining us on a current basis, I'll be looking next week for episode 3. Any closing comments, Brian, before I?
For investment vehicles, again, you know, be careful. It's the area that people kind of miss the grade on.
Yeah.
Believe it or not, it's just hard for me to fathom. Someone passing a Series 7, right, is failing the investment vehicle section on the Series 66. But it's because of these things. It's these things that are not showing up on the 7, like the life insurance and all this.
You certainly, like I say, 3-0 is so much better than 2-1. You just don't want to be in that position. So
exactly.
All right. Well, remember, inch by inch, your 66 is a cinch. Yard by yard, your 66 is hard. And then I'm thinking about getting your kicks on the Series 66.
There you go.
Brian.
Keep it simple. Stay with what you know. You take the test. Don't let the test take you.
All right, everybody.
Thanks, everybody.
See you
Take
next
care.
episode. Bye-bye.
Bye-bye.